Thank you, Naveen. I hope I'm audible.
Audible, Amit, loud and clear.
Thank you. Good evening, everyone who has joined this webinar. And as Naveen mentioned at the outset, that the agenda for today's discussion is the amendments proposed in the Income Tax Act, namely Section 37(1) and Section 194R. And therefore, we should start from where the seed is germinating, which is the Income Tax Act. So with that, I would invite my co-panelist, Jimit, who is a subject matter expert on income tax, to start with the corporate tax amendments and what are the issues which are being faced by the life sciences and healthcare sector, or the potential issues, I would say so. And then I would also request Ketan to join in along with Jimit in terms of bringing out the industry perspective in respect of these amendments from an income tax perspective. Once we do that, then we'll get into the indirect tax aspects, which I'll take it along with Ketan. So with that, may I invite Jimit to come in, please, and we'll put up the deck for the audience.
Thank you, Naveen and Amit, and good evening, everyone. So, Amit, would you be putting up the slides?
Yes, please.
Okay, so while Amit is putting up the slides, let me quickly lay out the context. Marketing expenditure of pharma companies typically encompasses expenditure incurred towards medical practitioners. These expenditures have generally included free product samples, items given as brand reminders, medical books and journals, travel and hospitality for medical conferences, medical equipments, gifts, etc. Deductibility of these expenditure has been a bone of contention between the pharma companies and the Indian tax authorities. To address this issue, Budget 2022 has brought in a significant amendment to Section 37 of the Income Tax Act. In addition to this, new withholding tax provisions in the form of Section 194R have been introduced to widen the tax net. These amendments are likely to have a major impact on the life science and healthcare industry. Also, in its recent decision, the Supreme Court of India has pronounced a critical judgment which will significantly impact this industry as regards its marketing activities are concerned. To start with, let's do a quick recap of the relevant regulations, circulars, and judicial precedents on the issue prior to the budget amendments. This shall help us understand and discuss the nuances of the amendments and its impact. So the key regulation, surrounding this issue is the MCI Regulations, that is the Indian Medical Council Professional Conduct, Etiquette and Ethics Regulations 2002. The MCI regulations governing the professional conduct of registered medical practitioners were framed under the Indian Medical Council Act 1956. Now, the Medical Council of India was constituted under the IMC Act and had amended the MCI regulations in 2009 to include Clause 6.8 to provide the code of conduct for doctors and professional association of doctors in their relationship with pharma and allied healthcare industry. In 2016, the MCI regulations were amended to delete the reference to Professional Association of Doctors. MCI regulations imposed certain stipulations and restrictions on medical practitioners in their dealings with pharmaceutical and allied healthcare industry. More recently, the National Medical Commission Act 2019, that is the NMC Act, has been enacted to replace the IMC Act as the primary legislation to regulate medical education and the medical profession in the country. Now, though the MCI regulations are framed under erstwhile IMC Act, by virtue of enabling provisions in the NMC Act, the provisions of MCI regulations should continue to apply till the new regulations are notified. Now, consequent to the notification of MCI regulations in 2009, which essentially referred to the introduction of Clause 6.8, the CBDT issued a circular in 2012. Now, as per the said circular, any expenditure incurred by taxpayer in pharmaceutical or allied health sector industries or other assessee for providing freebies to medical practitioners and their associations, which is in violation of MCI regulations, shall not be deductible under Section 37(1) of the Act, on the basis that these expenses are prohibited by law. Apart from the MCI regulations, it is also necessary to look into the other governing regulations for a holistic view of actions that can be viewed as permissible or prohibited. In this context, it is relevant to mention the Uniform Code of Pharmaceutical Marketing Practices, that is UCPMP code. Now, UCPMP code was published in 2014 by the Department of Pharmaceuticals as a guidance to the pharmaceutical industry for promotion and marketing of drugs and medical devices. At present, these guidelines are voluntary and do not have the force of the law, and therefore they are not mandatory. As per the UCPMP code, no gifts, pecuniary advantages, or benefits in kind may be offered to persons qualified to prescribe or supply drugs by a pharmaceutical company or any of its agents. It prohibits extending travel facility inside the country or outside, including rail, air, ship, cruise tickets, paid vacation, etc., to medical practitioners and their family members for vacation or for attending conference. As we speak, the matter is before the Supreme Court under a petition to make UCPMP mandatory. And as recently as Monday this week, the Supreme Court has passed an order seeking Center to file a counter affidavit within 8 weeks. Another relevant code is OPPI Code of Pharmaceutical Practices to 2019. Now, the Organization of Pharmaceutical Producers of India issued OPPI Code of Pharmaceutical Practices 2019, that is the OPPI code, which includes standards for ethical promotion of pharma products to healthcare professionals and helps ensure that the member companies' interaction with the healthcare professionals and other stakeholders are appropriate. OPPI is also a signatory to International Federation of Pharmaceutical Manufacturers and Associations Code, and it is obligatory on the member companies to adhere to the principles enshrined in this code. Now, again, like UCPMP, the final responsibility of implementation of OPPI code is a matter of self-regulation and self-discipline. OPPI code also provides detailed guidelines relating to member companies' interaction with HCPs, promotional material, hospitality, sponsorship, gift samples, etc. Moving on to next slide. Now, as we are aware, Indian tax authorities have often relied on MCI regulations when dealing with deductibility of marketing expenditure. These regulations are referred to in the 2012 circular and the budget 2022 memorandum as well. MCI regulations regulate the code of conduct of doctors. Let us now understand some of the key aspects of the regulations which are relevant in the present context. Regulation 6.8.1 is the most significant clause of the MCI regulations, which lays down the code of conduct for medical practitioners in their relationship with pharmaceutical and allied healthcare industry. It states that the medical practitioners are not permitted to accept any gift or other benefit from pharmaceutical and allied healthcare industry, such as travel facilities, hospitality, cash or monetary grants, etc. That apart, Regulation 1.5 of MCI regulations provides that every physician should prescribe drugs using its generic name only. Also, as per Regulation 7.11, a physician should not contribute to lay press articles or give interviews which may have an effect on advertising himself or soliciting practices. Further, Chapter 8 of MCI regulations also lay down certain punishments and disciplinary actions for the violations of MCI regulations. So in short, the MCI regulations governs the conduct of medical practitioners, essentially the doctors, and also lays down certain protocols that they need to follow. And in case of violation of any of the clauses, it also sort of provides for disciplinary actions that can be taken against the doctors. Moving on to next slide. In light of this background, we shall now discuss some of the key judicial precedents prior to the budget amendment. At the outset, it is imperative to note that the advertisement of drugs and medical devices is regulated in India, and the organizations may have to refer to multiple laws. For example, Drugs and Cosmetic Acts and Rules, Drugs and Magic Remedies Act, Consumer Protection Act, New Drugs and Clinical Trial Rules, Essential Commodities Act, Drugs Price Control Order 2013, and etc. and such other laws as well. So advertisement of prescription drugs are not permitted. Hence, pharmaceutical companies promote medicines through incurring expenditure towards medical practitioners in the form of free samples, conferences, brand reminders, etc., to make them aware of company's product with a view to increase sales. Having said that, the focus of the tax litigation so far has largely been with reference to MCI regulations and more specifically on clause 6.8.1 and the CBDT circular of 2012 issued in this regard. The primary contention of the pharmaceutical and the healthcare organization has been that the MCI regulations ought not to apply to them. The validity of MCI regulations itself was challenged with respect to its applicability to other than medical practitioners. Let us now discuss the key principles emanating from some of these relevant judicial precedents. Firstly, as regards the validity of MCI regulations, Delhi High Court held that MCI has no jurisdiction to go into the infrastructure facilities. MCI has absolutely no jurisdiction to pass any order affecting rights or interests of any hospital. In tax litigation, taxpayers, essentially the pharmaceutical and elite healthcare companies, have been trying to rely on this judgment to contend that MCI regulations ought not to apply to pharma companies, and hence there is no violation by the pharma companies, and accordingly there should not be any disallowance under section 37. In a writ challenging the CBDT circular of 2012, the Himachal Pradesh High Court dismissed it by upholding the validity of CBDT circular. However, the court mentioned that the deduction for expenditure may be claimed if the taxpayer can satisfy the tax authorities that the expenses is not in violation of MCI regulations. And thus, the High Court left the issue open for adjudication on merits. Tribunal have consistently held that MCI regulations are not applicable to medical practitioners only, are applicable only to medical practitioners and not to pharmaceutical companies or elite healthcare sector industry. Accordingly, expenditure incurred towards brand reminders comprising low-cost items have been held to be purely for the product promotion and cannot be reckoned as freebies given to the doctors. Additionally, it has held that sales promotion expenses incurred on distribution of gift articles to stockists, distributors, dealers, doctors, and pharmacists should be deductible. Expenditure towards in few other judgments, expenditure towards free samples given to test efficacy of the product and conference expenses constitute business promotion expenses and therefore were held to be allowed as a deduction. However, expenditure on distribution of free samples of established products to doctors was disallowed on the basis that the intention was to induce doctors to write prescriptions of the said products and therefore would be in violation of MCI regulations. Expenditure on leisure trips and entertainment of doctors and their spouses were held not to be tax deductible. Commission paid by pharma company to doctors for referring patients for diagnosis were disallowed as this were held to be against the public policy. Recently, in the case of McLeod's Pharmaceuticals, Mumbai ITAT, disagreeing with the decision of the coordinate bench in the case of PHL Pharma, recommended constitution of a special bench to consider the question as to whether or not an item of expenditure on account of freebies to medical professionals, which is hit by Rule 6.8.1 of MCI regulations, could be allowed as a deduction under Section 37(1) of the Act. So this has been the history of litigation prior to budget amendments and, of course, the Supreme Court ruling. Moving on to next slide. Yeah. So having discussed the history on the issue, let us now look at the recent developments that is gaining significance within this industry. Pending the reference to special bench, Budget 2022 brought in an amendment to Section 37 of the Act, clarifying that expenditure would be disallowed to the extent it represents a benefit or a perquisite and acceptance of which results in violation of any law, rule, regulation, guideline governing the conduct of the recipient. So there are dual conditions that need to be satisfied for disallowance to trigger. First being the activity should result in benefit or perquisite for the recipient, and in the present context, medical practitioner, and acceptance of such benefit or perquisite should be prohibited by any law, guidelines, or regulations governing the conduct of such recipient being the medical practitioner. This amendment specifically impacts the contention that MCI regulations are not to apply to pharma companies and hence disallowance under Section 37 should not be attracted. Soon thereafter, the Supreme Court pronounced a critical judgment in the case of Apex Laboratories. It held that freebies provided to doctors are prohibited by law and therefore expenditure in this regard should not be allowed as a deduction. In this case, the company had provided freebies such as hospitality, conference fees, laptops, gold coins, televisions, refrigerators to the doctors. According to Supreme Court, pharmaceutical companies cannot be granted a tax benefit for being a party to an act that leads to an offense. Recently, Kolkata High Court in the case of Peerless Hospitex held that the referral fee paid to doctors for referring patients to assess his hospital is prohibited and should be disallowed for tax purposes. And of course, it also relied on Apex Laboratories in pronouncing its or concluding its ruling. Thus, the key aspect is to ascertain whether any act of pharma or elite healthcare companies result in violation of not only the regulations governing the company, but also the recipient medical practitioners. Another critical amendment pertains to introduction of Section 194R, which casts withholding tax obligation in respect of any benefit or a perquisite provided to residents. Effective from July 1, 2022, tax at 10% is to be deducted before providing benefits or perquisites to a resident, where such benefit or perquisite arise to such a recipient from business or exercise of his or her profession. Taxes are not required to be withheld if the value provided or likely to be provided during the financial year does not exceed INR 20,000 qua the recipient. Now, Section 28(4) already provided for charge of tax on benefit or perquisites arising from business or profession, and this section has been there for donkey's years within the Indian Income Tax Act. However, many of these transactions have gone unreported so far. Thus, while these expenses are claimed as deduction by the companies extending such benefits, the recipients may not have been necessarily offering such benefits to tax. Withholding tax in terms of Section 194R is intended to bring such transactions within the tax net. Before we move on to next slide, maybe I will pause here and see if Ketan would like to share some thoughts on these developments.
Ketan, you're on mute. Please unmute yourself.
Sorry, I was speaking on mute. I think I am audible right now, I hope.
Yes, Ketan.
Yeah. So thanks, Jimit, and thank you, Taxmann Naveen, for basically giving me this opportunity to be on this panel along with my esteemed co-panelists as well. Coming to the present slide, where basically Jimit is given the update on the relevant developments that have happened from a law perspective, which impacts, I would say, healthcare industry, so to say. While I would basically want to go back to what Naveen mentioned, that these developments specifically in that sense do not mention that they are applicable only to pharma industry, but of course they have a very large impact on pharma industry as well. I would say that while there have been these developments like the introduction of explanation to Section 37(1), explanation 3 to Section 37(1), again, this explanation is an explanation to explanation 1, which was already existing. So effectively, this particular amendment or a development is not in that sense a new introduction which will create a new impact on the pharma industry, or for that matter any industry, so to say. It just emphasizes or explains or provides an additional, I would say, guidance in terms of interpreting explanation 1, which was again basically introduced to explain the provisions of Section 37(1) itself. So this kind of provisions have already been existing in the law since inception itself, and therefore whatever was earlier in that sense prohibited under the law was always I would say contemplated to be disallowed in the hands of the taxpayer. However, it has a bearing on the pharma industry largely because of, I would say, the kind of practice that has been happening, and with this ruling of Supreme Court, where there have been various, I would say, manner in which the pharma industry have been liaising with doctors or engaging the doctors for in the advertisement and promotion of their products, have clearly brought to fore certain, I would say, abuses which have been happening in the industry. And therefore, I think in that sense, this particular explanation is a welcome introduction to basically provide for curbing all of the abuses that have been happening. But if I have to again kind of read it from a very intention perspective, I think in that sense, it does not do any specific damage to pharma industry as well, other than curbing the abuse which if at all was happening, or probably if it is happening in that sense. In any case, any expenses which were in prohibition of law was never to be allowed, and it basically only emphasizes that the MCI guidelines, which were like guidelines specifically applicable to the doctors, would also fall within the ambit of the definition of law, so to say. Effectively does not change much for the pharma industry, because there already existed MCI guidelines. There was already a CBDT circular, and Jimit also alluded in the earlier slide that the validity of that CBDT circular was also upheld. So from that perspective, the disallowance was already existing, and it continues to basically remain at the same level itself. To the extent there is a violation, there will be a disallowance. If there is no violation, I think there's no disallowance as well, and therefore there should not be any cause of concern for the pharma industry with this introduction of new explanation, is shortly what I would like to, in that sense, sum it up. Not sure, Jimit, whether you basically align with this particular thought process, or you have a different view in terms of it enlarging the scope of disallowance in the hands of pharma industry and having any additional impact of pharma industry, so to say, more than what it was already existing before this introduction. How do you basically read this?
No, so Ketan, you have been right. You have been right in so far as that there should not be any incremental implication of these provisions, and somewhere Supreme Court ruling in Apex Laboratories does sort of aligns with the same thought process, because they never relied on the amended provision. They were purely relying on amended provisions of Section 37(1), an explanation that something that is prohibited under the law should be disallowed. And therefore, if going by the Supreme Court, they don't even need to rely on the amended provision, to curb the practices or the abuses that you have been mentioning. So yeah, I'm completely aligned, and you are right, so to say. The only one comment is that there have been some judicial precedents, which sort of where the tribunals took a view that the guidelines or the MCI guidelines ought not to apply to pharma companies. This provisions now tries and makes it amply clear, irrespective whether the prohibition is for the pharma company or in the hands of recipient, as long as there is a violation of the law, either of the parties involved will be a party to the violation and therefore result in a disallowance. So it just makes it amply clear,
Right.
and reliance on those judicial precedents will now become difficult.
Yeah, agreed as well. Perfectly in line with you. I think the only, I would say, the disputable points which were already existing, which was whether the MCI guidelines apply to pharma industry or not, has been set to rest. The second is whether the CBDT circular, so to say, was valid or not, has also been set to rest by bringing in that amendment within the law itself, and therefore basically the question of the applicability of CBDT circular no longer exists, at least from a pharma industry perspective. But I would say that this particular provision which has been introduced has rather an incremental impact on I would say other industries where there was no such CBDT circular already existing, and with this introduction being it very general, any industry which is guided by, and of course every industry for that matter would be guided by some ethical standards and code of conduct. If there is any violation in the hands of the recipient, the payer would also be subjected to disallowance. And therefore, I would say it has a more larger incremental impact on other industries, and they may be it may have a cause for concern for them. Pharma industries has already been aligning, and that is evident from the OPPI guidelines as well, which is an association of pharma industries, which itself has basically, I would say, come up with the code of conduct while promoting and advertising the goods, which more or less is aligned to the way the MCI guidelines also allude. So in that sense, the industry, government, and the Department of Pharmaceuticals, for that matter, are all aligned in terms of interpreting a particular law, and have always been kind of trying to come up with specific guidelines to have the law implemented in the intended form. The only thing which I feel should additionally had been done by the government or the finance ministry to provide an objective guidelines rather than just having kind of an explanation, which again is left for interpretation. by the tax authorities as well as taxpayers in that sense, which basically can still continue with some litigation, or rather may have some incremental impact on adding to some litigations which we may come up when we go through the future slides in that sense. So while it has tried to set to rest certain disputable points, but along with this introduction, there may be certain additional, I would say, interpretational challenges which may come into being and may add to litigation, which again would put an additional pressure on the judiciary. One such example, if I have to lay down from an explanation to Section 37(1) perspective, is that the Finance Act says that it is effective from 1st April 2022, that is assessment year 22-23 onwards, which means it impacts financial year 21-22, so to say. But the explanation reads that it was always intended to be meant so. So while it says it has a prospective implication, it says it was always meant to be said so, and causing a confusion, therefore, whether it is prospective or retrospective in impact, which of course, as a consultant, I would rather leave it to you for basically interpreting and helping the industry to maneuver through this confusion.
No, sure, Ketan, and for the time being, even if we assume that it is prospective, but with Supreme Court, anyways, there will be a retrospective impact of the Supreme Court ruling. So whether this amendment is prospective or retrospective may have a very little merit in, investigating that. With Supreme Court already being there, I think your historical transactions to that extent will have to be sort of revisited and in light of Supreme Court ruling, reanalyzed. In terms of whether there is a potential exposure of disallowance even on those transactions.
Right. So somewhere then this particular explanation becomes a bit of a redundant with already development from a Supreme Court decision perspective, as well as the Himachal Pradesh decision, which upheld the validity of CBDT circular. So to
That's
say,
right.
so far as it restricts itself to application of the MCI guidelines and
That's
impact
right.
on pharma industry. If at all we have to restrict it to the implications on pharma industry for that matter.
Right. No, thank you, Ketan. I think that was very insightful. So we can move on to the next slide. Yeah, thank you. So in light of Section 37 amendments and the recent court rulings, organizations, particularly in the pharmaceutical and allied healthcare industry, will have to review the entire universe of their marketing expenditure to determine the potential exposure of disallowance. The impact areas in this regard could primarily be the marketing and sales promotion expenses incurred towards the medical practitioners in the form of brand reminders, customary gift, medical books and journals, free product samples, conferences and seminar expenses, travel and hospitality expenses, honorarium camp expenses, grants for educational programs and trainings, etc. So the organizations will now have to undertake an impact assessment, which will encompass evaluation if the expenses constitute a benefit or perquisite for the medical practitioner, and whether the acceptance of these results in violation of MCI regulations. Now, as regards MCI regulations, one needs to address multiple aspects, such as what is the scope of medical practitioner? Would it cover a healthcare professional practicing, let's say, in any other therapeutic area like Ayurveda, homeopathy, etc.? What could constitute a gift in the absence of specific definition? Could low cost, say costing under rupees 1,000, brand reminder items can be excluded from the definition of gift? Is distribution of free product samples permitted under MCI regulations? Could that constitute a gift? So therefore, organizations will now need to identify nature of medical practitioner engagement efforts and type of spends. Analysis from a tax perspective could vary depending on the manner in which the spends are incurred, types of arrangements, nature and purpose of spends, specific relevance to the field's business in which the company operates. A detailed evaluation of marketing expenditure is warranted not only to identify expenditure that could potentially be disallowed, but also to assess its impact on the effective tax rate. Besides assessing the economic impact, organizations will have to discuss provisioning aspect as well with their auditors. On this, it is pertinent to note the impact of Supreme Court ruling on historical transactions as well, and particularly where you have years that are particularly open, or potentially there is a possibility of reopening as well. Additionally, the board of directors may also be interested to assess the impact from a governance perspective, particularly to assess if the activities, if prohibited under MCI regulations, could be construed as illegal or prohibited under law. So in view of these developments, organizations will have to review their overall marketing strategy and its effectiveness in terms of return on spend. It may be necessary to transform from the conventional practices and look for innovative approaches to marketing strategies. So again, Ketan, I would like to bring you in here and to, if you could share some more insights in terms of, how you think the marketing strategies of the organizations will have to, or will in future have to change, because of these developments.
Yeah, so Jimmy, thanks. I think you have rightly covered, suggesting that while these are the different nature of, I would say, expenses which pharma industry incurs as a whole for promoting a particular product. Of course, there may be different mixes that may be adopted by pharma industries. Since pharma industries are not allowed to publicly advertise, there have to be some ways in which the pharma industry can introduce a product in the market, right? Just a quiet introduction or a launch of a product may not really help. There has to be an active socialization, at least with the doctors, so that the doctors become aware of certain breakthrough therapies that have come into I would say existence, plus keep on reminding the doctors of an existing brands with a breakthrough therapies for that matter going off patent, and the medicine probably becoming generic, and with introduction of various competitive products coming in the market, it becomes imperative for the pharma industries to bring in different ways and means in which they basically keep the brand live in the minds of the doctors, and therefore these kind of brand reminders are adopted. Again, I would like to say that all of these are basically kind of different types of manner in which the pharma industries operates, and my views in respect of all of these will be my personal views, so to say, and does not specifically represent the organization that I belong to. Now, if we come to like specifics of brand reminders in clinic items, free product samples, and others, there are no specific guidelines available in the MCI regulations as well. And there's a larger bucket of particular item which probably may be considered to be covering these items is the clause on gifts. Now, as you also rightly identified, there's no definition in terms of what is a gift. Now, gift in a general parlance can be construed in two different ways. One, which is given free of cost or free of any consideration, can be considered as a gift. The other definition, probably also, which certain courts have also upheld, is that if it is given in consideration of love and affection, then it becomes a gift. So whether there is no consideration or whether there is a consideration of love and affection, only then does it become a gift, is again I would say matter of interpretation, which may need to be interpreted as well. Now, whether these brand reminders in clinic items are given out of love and affection, of course not. A pharma industry is, or rather a pharma company would always be in, I would say, business of promoting its product, and of course is not a natural person to have a feeling of love and affection, so to say, against qua a doctor. And the purpose of brand reminders, as I said, is for the purpose of advertisement. Any business organization should therefore be allowed to legitimately advertise its product, and to the extent it is in that sense legitimately done and not violating the guidelines that is being broadly provided to. And so I think somewhere there is a subjectivity that gets involved also in this particular interpretation. What constitutes I would say reasonable element of an advertisement, and where does it cross that particular line to become a benefit or a perquisite or a gift in the hands of the doctor, needs to be very carefully, I would say, evaluated. And if that is done, and I think at a substance level, if the company is able to basically establish that it was purely the kind of engagement that they did with a doctor by providing certain items was purely from an advertisement perspective and would not basically under any stretch of imagination be considered as a benefit or a perquisite in the hands of the doctor, then I think we should be able to claim it as a allowable expense and should not be treated as in violation of MCI guidelines under the heading gifts. Again, one particular aspect which I would like to suggest is that I also basically in that sense am aligned with the view which courts have given in the past, suggesting that what is not acceptable in the hands of recipient or what is prohibited by law in the hands of the recipient should also be deemed to be prohibited by law in the hands of the giver as well. So what is unethical in the hands of a recipient is unethical in the hands of payer too. Now, if we have to draw the same analogy, if there is no consequence of a particular act in the hands of the recipient, it should have no consequence in the hands of the giver as well. Now, again, coming back to the definition of gifts, while the MCI guidelines specifically mention that the medical practitioner is not allowed to accept any gifts of any nature, when we go to the consequence of it, it says that if the value of the gifts is exceeding 1,000 rupees, only then there are some consequential implications on the doctor, but there are no consequences if the value of the gifts is less than 1,000 rupees. Does that mean that any item of brand reminder or in clinic item, if it were to be treated as being covered under the definition of gifts from an MCI regulations perspective, if the value of such an item is less than 1,000, it should not be treated as a violation under the MCI regulations? Is again a matter of interpretation, I would like to say, but this needs to be kept in mind as well. And this needs a proper clarification. And therefore, when I spoke about it in the earlier slide, that while the government has tried with introduction of this, I would say, amendment to set to rest the litigation which was already existing, it should have rather done by providing a very objective guidelines or making the UCP/MP code more objective and mandatory on the pharmaceutical industry, and basically provided under section 37(1) specifically for pharma industry that any expenses in violation of the UCP/MP code should be disallowable, would have made the life of the assessing officer much more simpler. Because with this particular introduction and the kind of media hype that this particular introduction has received with respect to specifically the pharma industry, the assessing officer would always be under a pressure while assessing the tax return of a pharma industry to consider allowability of all advertisement and promotional expenses that a pharma industry would incur. And somewhere we'll have to sit in the chair of a medical counsel to evaluate whether a particular expense incurred by pharmaceutical company is in violation of the MCI regulations or not, while he has no wherewithals or jurisdiction to do so. But because of this introduction and the kind of media attention that this particular provision of law has received, he will have to discharge that onus as well, which basically, as I think Naveen was also kind of suggesting in the past when he was broadly describing it, suggesting that somewhere whether it needs to be proved to be a violation or whether just a conduct with a perception of it to be in violation could trigger this disallowance, again will become a matter of dispute before the courts of law. So all of these again are adding to the litigation, and the judiciary will be burdened with all of these litigations coming up to them, despite the introduction of this law or this provision, which was sought to, I would say, reduce the burden on judiciary. But it's somewhere falling short of giving a complete clarity for that matter, I would say.
No, absolutely. The lack of clarity, while the intention of the government is to reduce litigation, but the lack of clarity, only and subject to potential interpretations will only, lead to more and more litigation. Just quick reaction on the point of whether the gift has to be out of love and affection. And I know in the past taxpayers, particularly in the corporate share transfers, have taken a view, love and affection is not necessary for taking section 47 exemption of, gifting of shares by one company to another, and courts have upheld that. And now taking a different view, probably we'll have to see how tax authorities are or the courts are going to react on that. On rupees 1,000 threshold provided, it's only a threshold for levying a penalty, but any sort of gifts is prohibited under MCI regulations. Theoretically, even a gift of 1 rupee is prohibited. So again, you're right, how the person sitting and how capable he is, to review the MCI regulations, to take a call on whether something is prohibited or not prohibited. It'll be interesting to see how this matters once they progresses and goes through different level of courts. We will have to see how this sort of pans out. And the last one, the most interesting point that you made is the aggressive investigation that these provisions will lead to because of the pressures on the tax officers. So all the legitimate transactions, advisory arrangements or consultancy arrangement with doctors will also now be looked at with more suspicious. So it's important that your documentation trail is robust enough to sort of evidence the intention behind such advisory engagements, that if there was any report that was received from doctors were indeed used or considered for your business, rather than just kept on records and no further action was taken. So I think there will be aggressive investigation and documentation will become key. So moving on to next slide.
So on a lighter side, basically this reminds me of a kind of a phrase which says that under litigation, it's not the appellant or the defendant, but it's the judge which is on trial. I think this particular introduction will emphasize that particular statement very strongly, I would say, in that sense. Because from a pharma industry perspective, as I said, having the OPPI guidelines and the compliant companies within the industry have been following it to the T. And even from that matter, the MCI guidelines, so to say. OPPI was aligned, companies are aligned. The tax authorities were also, in that sense, following the CBDT circular, were basically discharging their duties appropriately. Now, as you said, with this particular pressure, I think it's more a cause of concern for an assessing officer to rightly do so. But if he has to again adopt a shortcut method, we'll probably disallow everything and put it on judiciary to decide. And therefore, again, the judge will be on trial.
Good thought. Yeah. Okay, moving on to next slide. So the provisions of newly introduced withholding tax section 194R are likely to impact benefits in the form of brand reminders, distribution of books, fee, product samples, sponsorship for seminars, etc. It would also impact incentives and rewards to stockists, super stockists, distributors, etc. So this shall require organizations to review their marketing and incentive schemes so as to evaluate applicability of these withholding tax provisions. Considering the wide ambit of the provisions, a single transaction could actually lead to a dual withholding tax implications. For example, if an organization arranges a travel for the distributor or a medical practitioner, then the organization may now have an additional withholding tax obligation on the travel benefits provided to the distributors or medical practitioner. This is independent of whether the organization will undertake tax withholding on payment to travel agent. Further, there could be significant challenges in case of multi-layer distribution chain. Additionally, in case of non-monetary benefits, withholding tax will have to be undertaken on a grossed-up basis if the company providing these benefits is bearing the cost. This will increase the overall cost of the transaction. It may be useful to revisit the overall marketing strategy and consider alternatives, if any, for better cost efficiency, value, and ease of implementation. It would also be relevant to ensure that internal systems and processes are geared up and able to identify and track benefits or perquisites such that withholding tax obligation is appropriately discharged. As regards monetary benefits, it could be argued that the provisions ought not to apply. However, since the specific exclusion, the possibility of alternate view cannot be entirely ruled out. Valuation of non-monetary benefits could be another area of challenge. Again, while these provisions are objectively introduced, and as we discussed a while back, lack of clarity as regards some of the practical aspects have made the implementation very subjective. Although the intention of the budget is to reduce litigation and plug certain gaps, lack of clarification and subject to possible interpretations, litigation may not be entirely alleviated. Also, considering that the timeline to implement is approaching soon, organizations will need to move fast in identifying the withholding tax obligations and implementing necessary processes to ensure due compliance. Also, this matter merits close attention now since there is a significant possibility of dual impact, that is disallowance of expense in view of amended section 37 and in light of Supreme Court decision, and also withholding tax cost with grossing up if tax is to be borne by the company. Therefore, it is critical to explore the possibility of more efficient alternatives. Again, I will pause here and allow Ketan to come in and share his thought process or insights on the new withholding tax provision.
Yeah, so I think yes, Section 194R in that sense has really been a cause of concern for every taxpayer, for that matter, or every business in that sense. Uh, uh, and as you rightly identified, there are various challenges in interpreting or rather implementing this particular provision. While the provision sounds to be quite simple, that benefit and perquisites, which was anyways contemplated to be taxed in the hands of the recipient always, will now basically be subjected to withholding tax. It's as simple to say as that, but it's very difficult to implement it. Uh, 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 but the thing is, one thing which, while looking at this particular slide, while I was surprised, is that the first box which you have mentioned as stockist margin or discounts to distributor, would that be treated as a separately taxable benefit or perquisites in the hands of the distributor? But by at least allowing the margin or the discounts to the distributors, that anyways would be in a normal case of course of business itself be offered to tax by the authorities, and it's part of the sale of goods, which anyways is subject to withholding tax by the I would say purchaser in that sense. So how would that basically be treated separately, or rather would it still be treated separately as a benefit or perquisite in the hands of the distributor? I was surprised to see that. If you can just help me navigate this particular aspect.
No, so you are right. One argument is that this is monetary in nature, and as you rightly mentioned that if there is a discount, then certainly the cost of purchase is reduced, and to that extent, it's already factored in your profit margin, and should not there should not be any case of tax evasion or tax avoidance. And again, it's a monetary in nature, so our prima facie view is that that should not have any concerns from 194R perspective. So that way you are right. But again, the language of 194R is such that we need to nonetheless evaluate this and rule it out.
Yeah, I think yes, you are right that it will give innovative ways to the assessing officer to tax certain normal things as well
Right.
within this
Right.
particular definition, and rather put a burden on the payer to have withheld the taxes and create a
Sure.
new set of litigations from a payer's perspective. But yes, I agree in that sense. Whenever there is a benefit of perquisites, now specifically coming to a non-monetary one, how do we really implement it? How does a system specifically capture the timing and the discharge of it? And how do we demonstrate that the withholding tax had therefore been done on a timely basis? All of these will again become kind of I would say an implementing difficulties for the pharma industries, and large organizations will surely have to rely on technology for this particular thing, and developing technology within this short frame of time that has been allowed by the government, of course, will make the life more difficult for the taxpayer. Again, on the valuation aspect, where you mentioned like there may be a particular value in the hands of the payer, but what exactly it means for the recipient, and how should therefore the value be basically considered? Whether it will be like if I am like if I look at the FMCG industries, they do distribute certain gifts and other things to their performing stockists or distributors. Now, if they are providing such gifts or I would say sales promotional items to their distributors, whether the cost in the hands of the FMCG company providing it, or whether the benefit which the distributor basically would value in the hands of the distributor itself would be considered as a value for the purpose of deduction. And all of these questions are yet to be in that sense answered, and would really create a lot of litigation if I look at this particular provision from an FMCG industry perspective. Of course, pharma industry as well has certain aspects, but the kind of rampant sales promotional benefit and perquisites that are provided in the FMCG industry are more than the kind of benefits and perquisites that are provided within the pharma industry from a B2B perspective, if I have to look at it.
No, that's right, Sid, and it's an interesting point, and we have been dealing with situations where a bulk product is procured by a large FMCG company to be distributed to all its distributors as a gift, and therefore let's say a product was, the MRP was 100, they are able to procure at 80 because they are buying in bulk. But when they are giving out to distributor, he sees a value of 100 worth of gift that he's got. So yeah, from a valuation perspective, should we consider 100 from 190 for our perspective, or should it be 80? So it's a very valid point, and these are essentially the challenges that one has to deal with, when looking at situations. So thank you, Ketan, and thank you, Naveen. I think I would now like to hand over to Amit to sort of discuss some of the key indirect tax implications associated with these developments, and then we can sort of open it for question and answers.
Thank you, Jimit and Ketan. I think that was quite exhaustive in terms of the amendments that are proposed and also the impact on the industry and more so on the healthcare sector. And Ketan, I do agree that on the last point of yours that the 194R is not, and also Naveen alluded to it at the beginning, that this is something which is going to impact whichever company has a longer distribution chain, right? And there are schemes and incentives offered in the distribution chain for distribution of goods. So we'll come to that later. Maybe I'll quickly take you through the thoughts that we have in terms of the impact or the potential impact of the amendment in section 37. Now, at the outset, when this amendment came, we did not think immediately that there could be a potential impact even from a GST standpoint, right? And it was only confined to the aspect of how it would impact taxpayers from an income tax standpoint. But when we looked at it in a more evolved manner, and when we started discussing with healthcare sector specifically, it also opened an angle of how it could impact the indirect tax credits or the GST credits in the hands of the taxpayers. More so because if something is regarded as unlawful by virtue of a statute, which is the Income Tax Act for this matter, could that also have a potential bearing on the credit eligibility from a GST standpoint? A case in point over here is where in a recent advanced ruling, the Gujarat Advanced Ruling Authority looked at the CSR rules to decide on the eligibility of input tax credit on the CSR expenses. So therefore, it is quite prevalent that GST authorities can also look at the law or the other regulations to look at from the eligibility standpoint. So consequently, there is an additional condition which is not prevalent in the GST law today, but because this section 16 says expenses which are in the course of furtherance of business and something which is rendered unlawful from a business standpoint for deduction purposes in income tax, could that have potential impact on the GST credit eligibility is something that we need to ponder upon. And therefore, the other associated impacts about marketing spends, as Jimit was also giving the examples, we might need to also look at what is a benefit and what is a marketing spend. When I say benefit, a benefit to a healthcare professional as an expenditure that we incur in our books, could that be subjected to a GS1? Could those expenses be regarded as ineligible for GST credit if we are taking those credits today? And something which can be regarded as a marketing spend and can be asked, and we can still argue that it is for furtherance of business. The other aspect is about the gifts. Now, we discussed about from a direct tax standpoint what is gift and what could be argued potentially. And even on gifts, because of the section 17.5 restriction, is there a way and what could be the items which can be potentially ineligible? Because brand reminders, samples, etc., certainly are a kind of in the eyes or in the ambit of the GST authorities from a liability standpoint, right? And lastly, could it also impact the previous period? Because GST is completing 5 years in June, and because of the Supreme Court decision and the retrospective impact of that, could it also impact one more area for the GST audits which are happening now in terms of critically evaluating the eligibility of GST credits on this kind of marketing spends, which kind of emanate from the income tax assessments which might happen because of the Supreme Court ruling or the potential impact of that. So these are some of the important areas that we need to keep in mind when we look at Section 37 amendment in light of GST. So very quickly, Ketan, would you have any additional industry insights over here from a GST standpoint before we move to the Section 194R amendment? Ketan, you're on mute, please.
No, I think you are right, Amit. While the provisions have been introduced only in Section 37(1) under the Income Tax Act, it has a larger implication for the taxpayer or for the business, so to say. Of course, one of the aspect is the input tax credit under GST, which will also be evaluated in light of Section 37(1) interpretation, whether it is for the purpose of business or not. Because 37(1) broadly basically is a residual section under the Income Tax Act, which allows all expenses which are not covered elsewhere to be allowed if they are basically for the purpose of business incurred during the year, for the period for which it is being assessed, and not in prohibition of the law. So if it is treated as in prohibition of law, probably it could also be interpreted as not for the purpose of business, and therefore it will be extended to the interpretation under GST that it is not for the furtherance of business, and hence the ITC on that particular expense could be basically become an additional point of litigation under the GST law as well. But apart from GST, I would say the interpretation under 37(1) will also have an implication from a reputation perspective, because if there's a disallowance in the hands of the taxpayer suggesting that it's in violation of law, probably it could result into implications under Prevention of Corrupt Practices Act, under unethical, basically restrictive trade practices act, and other aspects as well. So basically, while it is only an introduction under the Income Tax Act, it has a far-reaching implications under various other laws as well, including for that matter GST. While GST does not have a specific, I would say, provision which basically disallows any expenditure which is in violation of law, if it is proved that it is for the furtherance of business, I don't think there should be a further disallowance under the GST. Only basis an interpretation under Section 37(1), because I think from an interpretation perspective, if there is a provision under a specific law, it has to be basically interpreted only for its impact under that law itself. While it may have some recommendation value under the other laws, but effectively, I think if we are able to successfully demonstrate to the tax authorities and the judiciary that while it may be treated as a violation, it was still a legitimate advertisement and promotional expenses for the furtherance of business in the hands of the pharma company, then I think there is no specific provision under GST which may basically disallow the ITC on such an expense, unless it falls within the definition of gifts or free samples or personal in nature or entertainment in nature, so to say. If it falls in any of those categories, of course, Section 17 and other sections under GST regulations may get triggered, and the disallowance of ITC will, I would say, stand for sure. But only on an interpretational aspect, I agree to your point of view. There will be challenges that will be faced by the pharma companies during the audits and establishing the bona fides of that expenditure from a business standpoint perspective before the GST audit authorities, for sure.
Right. And thanks, Ketan, for that insight. I think the other important last point on this from my side is, as far as you touched upon a very valid point on reputational aspects. I think that's very, very valid for any company for that matter, right? And therefore the way from again bringing the GST authorities over here in terms of the way the audits or investigations are conducted these days, and the amounts are quite significant for any company for that matter, it could have a potential impact where if the interpretations are extended at the ground level and which can open more areas of litigation. If I would say one more window of litigation, which we are seeing today in terms of the GST administration. So moving on to Section 194R, I think this is we all agree that this is much beyond pharma and healthcare sector and where there is a long distribution chain. And the simple thing is that we have seen in the past that tax authorities do reconcile 26As with the GST returns or service tax returns and also the income tax return. And consequently, they would like to impose tax or GST on the differential amount which is not reported in the GST returns, right? So just from a very simplistic standpoint, any TDS deducted on account of Section 194R, which gets reflected in 26As, the channel partners could be asked for questions by the GST authorities also. So that's the added complication which the provision brings in. Also, although Ketan, you mentioned it appears to be very simple when we look at it in a very from an income tax standpoint. And secondly, if you recall, there was one more circular. There was a circular of 105 in 2019, which was rescinded later on post-supply discounts and potential impact of GST impact on potential post-supply discount. Even there were principles which could create observations, interpretations from the authorities on this kind of deduction, on this kind of TDS deductions. More to say that if there is an incentive given to a distributor, which compensates or props him to sell more, whether that incentive could be added to the value of taxable supplies made by the distributor, because that was one of the principles which the circular wanted to cover. Similarly, if the 26As reductions that we are going to have, is this a supply from the distributor to the pharma company or to the brand owner or to the manufacturer, is something that has to be seen. So it makes, I would say, the entire incentive scheme or sales promotion schemes where this 194R could get triggered even more complex, because then you are not only looking at the compliance of 194R, you also need to evaluate so your channel partners are going to be aware of the potential GST consequences and whether they are going to comply with that, and whether as we brand owners and manufacturers, how we could support them in terms of those in terms of those implications. And this could potentially change the way we have been traditionally seeing the incentive schemes also, right? So it may not be the same way that we would be looking at the schemes because of this particular provision, specifically if these are non-monetary incentives or commissions or whatever we may call as incentives given to the channel partners. So 194R is certainly a very, very wide area for interpretation for even the GST authorities, and in some way could be looked at as a very silent entry of the already rescinded circular, if I may say so, because that could have a potential impact in the thought process of how GST authorities are going to look at this change. So, Ketan, do you think that the industry is kind of looking at this change from a holistic standpoint, and could you also share some insights how this could potentially impact the incentive schemes in future?
So I think you have a valid point, which effectively I had missed observing as well as an industry person. Now, when I hear you, I think it basically really makes me rethink in terms of whether it could have an implication from an ITC or a GST perspective as well. Now, from a pharma company perspective, of course, when I am providing a particular incentive or a benefit, it has basically, the thing is, it may not have an implication on us, because when I am particularly buying a particular product to be provided as an incentive or a benefit of perquisite to the distribution channel going ahead as a part of sales promotion exercise, I have already paid the GST to the supplier. I have availed the credit because for sure it is for the purpose of furtherance of the business. The only impact it may have is from the channel perspective, when the recipient may basically receive this. Currently, while under the GST regulations, GST is payable on transaction value, and the transaction value for this particular aspect may be zero, because it might have been distributed free to the distributor. But if there is a notional value imputed for application of Section 194R and is reported under 26As, that could be picked up by the GST authorities and may be taxed as kind of an income in the hands of the recipient, and the recipient may be therefore asked to discharge that GST liability, or basically there may be a need going forward if basically it had to be interpreted in that particular manner, where the distributor will have to raise a GST invoice to receive such a benefit in kind from the industry. So all of these, of course, may get gradually evolved, but from a very, I would say, strict interpretation of a law perspective, I would still want to stick to the interpretation point where the GST is strictly on the transaction value, and if the transaction value, irrespective of whatever notional or fair market value it may have in the hands of the recipient, if the transaction value is zero, GST should not basically get triggered. If it has a legitimate rationale, commercial rationale of basically treating the transaction value to be zero.
Yeah, and again, to add to your argument, legal argument, Ketan, is this a supply first and foremost, right? And therefore, at the first place, and therefore, do we need to look at the implications of GST thereon, right? So
Right, true.
I think that is something which we need to all first ponder upon.
Cross that particular aspect. First,
Yeah,
yes.
so just extending an incentive which might warrant a deduction of under 194R, does it constitute the supply under the GST provisions? And therefore, are we required to pay a tax and then come to the valuation aspect? I think that's the more fundamental aspect that one needs to also consider, right? So I think we are at 6:15, and I would request if there are questions from the participants. Naveen, we could take some questions before we close this session.
So yeah, Amit, I have shared some of these questions in the group. So before we start answering these questions, so one of the point I have raised at the beginning of this webinar, that is regarding when do you prove if the offense has been committed. So though I would leave it to the judiciary to decide, but I think there are few cases which I should bring to the notice of all our participants. And one of the principle of presumption of innocence, so which says that everyone charged with an offense shall be presumed innocent until proven guilty according to the law. And these principles have been approved by the Supreme Court in the case of Narendra Singh versus State of Madhya Pradesh, and Ranjit Singh Sharma versus State of Maharashtra. However, the Supreme Court in another case, in the case of Shakuntala Shukla versus State of Uttar Pradesh, has also affirmed that once the accused has been convicted by the learned trial court, there shall not be any presumption of innocence thereafter. So on that question, we can assume that just on the basis of allegations, we can't say an offense has been committed unless and until at least the trial court has taken a stand, has convicted the person of committing an offense. So that's the point I think I should highlight before we start taking the questions. So far, Amit and Jimit, we have 4 questions. So do you want me to read these questions, or you want to read them from the group? I have just posted them on.
Yeah, I think it makes sense for you to read it first, Naveen, if that helps.
So the first question is, what if the pharma company invites a doctor and pays him a huge speaking fee for one of their conferences and deduct tax under section 194J? Will 37(1) be triggered? Jimmy.
So, I mean, I am quite, I mean, it's interesting when there's a huge speaker's fees. I mean, a speaker fees would have been more reasonable. Anyways, I think it's important to understand the topic on which the medical practitioner is coming and speaking, and what is its relevance with the business of the organization. That's point number 1. What is the reasonableness? Because, you know, when you say huge speaker fees, and if it's unreasonable, then it shouldn't really appear as a merely an act of gratification to the doctor. So that's another important aspect, and why I'm saying that if you look at clause 6.8.1D of Medical Council of India regulations, it says that a medical practitioner shall not receive any cash or monetary grant from any pharmaceutical and allied healthcare industry for individual purpose in individual capacity under any pretext. So it's important, while it has to be in line with your business, it has to be commensurate with the business of the organization, and it has to also be reasonable. because it should not merely appear as an act of gratification to the doctors, considering that we have 6.8.1D of MCI regulations.
All right. So thanks, Jimit. So another question is discounts, margin schemes.
Sorry,
given to-
sorry, Naveen, maybe Ketan, if you want to add anything on the speaker.
Yeah, sorry, Naveen, to interpret again. I would just like to add to what Jimit said. There's also another clause in the MCI regulations which talks about affiliation. So if a medical practitioner, while speaking, is basically appointed as an affiliate to provide certain training or act as an advisory board or on an advisory board for the pharma company, and if that particular speaker fees could therefore be be demonstrated to be falling within this clause of affiliation. And I think, as Jimit also mentioned, if the kind of fees that we are paying are reasonable, because the clause also reads that the medical practitioner, while taking up any of such advisory activities for a pharma company, should ensure that his professional integrity and freedom are maintained. Somewhere where the statement starts, I thought there was already a summation that the fees were unreasonable by mentioning it to be huge, and therefore it may of course have an implication, or rather it is what is intended by the querist, that it will have an impact on the professional integrity and freedom of the medical practitioner, because these are really huge, so as to be reasonable from a speaker fees perspective, and therefore it could be treated as a violation under this clause as well, and may therefore be liable to be disallowed, irrespective of whether there has been a tax deduction or otherwise.
Yeah. Thanks, Ketan. So other question is, how do you see the applicability of 194R if any discount or margins has been given to the trader by giving them the credit notes? Do you see any applicability of 194 in this situation?
So I would equate a credit note to a monetary benefit, and on that basis we can take a view that 194R ought not to apply.
Yeah, definitely. There is one more judgment. I am not recalling the name of that one. So in fact, so we have a similar provision under TDS, which requires a deduction of tax in case of lottery and all. So if the payment is in kind, only then section 194R should be applicable. So if the payment is in cash, so we have another section 194C, we have I or J. So if it falls in any of these sections, then tax should be deducted under these sections, and 194R should not be applicable in that case. So we have another issue is, will discount extended to retailers by companies either directly or through distributors will be subject to TDS? I think these two questions are connected, so we can skip this.
Right.
And the last one is, in case of schemes for distributors, some taxpayers prefer to sell their scheme article or good to distributor at nominal value with GST thereon to avail ITC and pass ownership. Would that change now? So that's the last query. I think that would be for Amit to answer.
Sorry, I was having some problem in unmuting myself. So in terms of I think Ketan did touch upon that point of valuation. But as I said, the first and foremost thing in GST is, are we talking about a transaction of supply, right? I think that is first that we need to look at. So while there was a circular which the CBIC had brought out on post-supply schemes, post-supply discount schemes, which was rescinded later on account of industry representations, and because it went beyond the obvious the supply transactions. Now, if we are talking about nominal value, I think that's a very dangerous term, according to me, from being an indirect tax professional, because when we are talking about valuation, we have to follow the principles of valuation given in the GST law, right? And again, depending on whether it's a transaction with a related party or an unrelated party, would also need to be evaluated when it comes to valuation of goods. But first and foremost, if you're looking only from a 194R perspective, as we mentioned earlier, we first have to see whether the TDS deduction, which might happen on account of compliance of 194R, also leads to a supply under the GST law, and therefore there is an implication that we need to comply over there, and then only the aspect of valuation would come over there.